Goldman's new 12-month silver target, $267. Current price, approximately $74. That's a 260% upside projection from one of Wall Street's most conservative commodity desks. Goldman doesn't publish triple-digit percentage return forecasts unless conviction is high and risk-reward is asymmetric. The target itself is a signal. It tells you Goldman believes the move ahead is larger than anything silver has experienced in modern markets. When the bank that called every top for 8 years now projects prices this high, they're not forecasting a rally. They're positioning for a regime change. Let me start by establishing what makes Goldman's commodity research different from most sell-side analysis. Goldman Sachs operates one of the largest physical commodity trading operations on Wall Street. They don't just analyze metals, they trade them, warehouse them, finance them, and structure derivatives around them. Their research desk has access to proprietary flow data, client positioning, and real-time supply chain intelligence that most competitors lack. When Goldman publishes a target, it's informed by what they're seeing in actual markets, not just what's visible in public data. That context makes the $267 target particularly significant. The magnitude of the projection is what demands attention. A 260% return over 12 months is extraordinary for any asset, but especially for a commodity traded as heavily as silver. Goldman's commodity desk is not known for aggressive forecasting. They tend to cluster near consensus, adjusting targets incrementally as data evolves. Outlier calls are rare. When they do publish extreme targets, it's usually because internal conviction is so high that the reputational risk of being wrong is outweighed by the risk of missing the call entirely. $267 is an outlier call. It's 3.5 times current price. That's not a tactical trade. It's a structural repositioning. What makes the target even more notable is the context in which it appears. Goldman held an underweight rating on silver for 8 consecutive years. That rating was maintained through the COVID rally in 2020, the industrial demand surge in 2023, and the early stages of the current advance. Underweight didn't just mean neutral, it meant they actively recommended that clients reduce silver exposure relative to other commodities. That stance just reversed to overweight, with a target that implies silver will be the best performing major commodity over the next year. The distance traveled from underweight to overweight with a 267 target is enormous. It's the kind of move that only happens when the thesis changed completely. The report's language is worth examining closely because it reveals how Goldman's analytical framework shifted. Their previous research emphasized supply surplus, weak investment demand, and mean reversion to historical price ranges. The new report describes a supply deficit that cannot be resolved through incremental mine production or scrap recycling within the forecast period. It discusses policy-mandated industrial consumption that creates baseline demand insensitive to price. It highlights refining capacity constraints that limit conversion of mined concentrate into deliverable metal. Every element of the bearish case disappeared and got replaced by structural bull arguments. That transition didn't happen overnight. Goldman's research team has been incrementally adjusting language for months. Early reports acknowledged tightening but called it temporary. Later reports noted persistent strength but attributed it to speculative flows. The progression was visible to anyone tracking their quarterly outlooks. But the formal flip from underweight to overweight, combined with a $267 target, is the moment the gradual adjustment became an official reversal. It's Goldman saying publicly what their positioning likely reflected privately for some time. The structure of the silver market has changed in ways that make the old thesis obsolete. Now let's address why the specific number matters. Goldman could have upgraded to overweight with a target of 120 or 150 and still represented a significant bullish shift. Instead, they went to 267. That precision suggests the target is derived from a specific model or calculation rather than being a round psychological level. It implies Goldman's analysts ran scenarios around supply availability, demand trajectories, and price elasticity, and concluded that 267 is the level required to ration demand down to match constrained supply. The target isn't aspirational, it's mechanical. The timing of Goldman's flip is revealing in a different way than Bank of America's. BofA flipped at $74 after silver had already rallied substantially from its lows. Goldman flipped at approximately the same price point. Neither institution is leading the market. They're both validating it after the fact. That's important because it means the move happening now is not driven by Wall Street research calls. It's driven by fundamentals that Wall Street is only now catching up to and acknowledging formally. When the two most influential commodity desks on Wall Street both reverse bearish stances within weeks of each other at similar price levels, it confirms that something structural forced their hand simultaneously. One of the most interesting aspects of Goldman's report is its treatment of investment demand. For years, Goldman argued that silver's rally attempts failed because investment demand was fickle and speculative. Money would flow into silver during risk-on periods and flow out during risk-off, creating volatility but no sustained trend. The new report acknowledges that investment demand is rising, but frames it differently. Instead of speculative flows chasing momentum, Goldman now describes strategic accumulation by sovereign entities, institutional recognition of supply constraints, and defensive positioning against monetary instability. That's a fundamentally different characterization. It treats investment demand as structural rather than cyclical. The shift in how Goldman discusses China is also significant. Previous research treated Chinese silver demand as discretionary and price-sensitive. The new report describes it as policy-driven and inelastic. China's push toward energy independence, technological self-sufficiency, and manufacturing dominance all require silver-intensive industries: solar panels, electric vehicles, advanced electronics, grid infrastructure. Goldman now projects Chinese silver consumption will grow regardless of price because the strategic imperative outweighs cost considerations. When the world's largest commodity consumer treats silver as a strategic necessity rather than a discretionary input, it changes the entire demand outlook. Goldman's analysis of supply is where the report gets particularly technical. They break down silver production into primary mines, byproduct extraction, and recycled scrap. Primary silver mines account for roughly 30% of supply, but face the most constraints. Permitting timelines have extended, capital intensity has increased, ore grades are declining. Byproduct silver, which comes from copper, zinc, and lead mines, accounts for most supply, but is inherently inelastic. It rises and falls with those base metals, not with silver prices. Scrap recycling responds to price, but has hard limits based on available above-ground stocks and recovery economics. When you model all three sources, Goldman concludes that global supply can't grow faster than 2 to 3% annually under any realistic scenario. That's the constraint that forces price higher when demand rises. The report also addresses the role of refining, which has become increasingly central to silver market dynamics. Even if silver is mined, it must be refined to specifications that markets demand. Refining capacity is concentrated geographically, running at high utilization and slow to expand. Goldman's analysis suggests refining has become a binding bottleneck independent of mining supply. That means even if more silver were mined, it might not reach markets quickly enough to relieve shortages. This is a structural issue that traditional supply-demand models often overlook because they assume refining is frictionless. Goldman's target incorporates refining constraints explicitly, which is one reason it's higher than many competitors. Another element worth noting is Goldman's treatment of exchange inventories. Previous research dismissed inventory drawdowns as temporary or cyclical. The new report treats declining inventories as a signal of structurally insufficient supply. Goldman tracks not just COMEX, but also London, Shanghai, and other regional warehouses. All of them are drawing down. Some have fallen to multi-year lows. When inventories decline globally and simultaneously across different market structures, it's not a regional issue or a temporary phenomenon. It's evidence that demand is exceeding supply across the board. Goldman's model assumes inventories will continue falling until price rises enough to either reduce demand or incentivize new supply. At current trajectories, that equilibrium price is $267. The report's discussion of industrial demand is particularly detailed. Goldman breaks it down by application: photovoltaics, electronics, automotive, medical, and infrastructure. Each category has different demand drivers, price sensitivities, and growth trajectories. Solar is the fastest growing segment and the most policy-driven. Electronics demand is stable and mature. Automotive is accelerating due to EV adoption. When you model each segment independently and aggregate them, the total comes to demand growth that far exceeds what supply can match. Goldman's analysts conclude that even if some applications reduce silver content or substitute alternatives, total industrial demand will still outpace supply for at least the next 3 years. The target also reflects Goldman's view on the role of financial markets. Previous research assumed that paper silver markets, futures, options, ETFs, would keep physical prices tethered through arbitrage. The new report acknowledges that arbitrage is breaking down. Premiums for physical over paper are widening. Delivery delays are extending. Exchange inventories can't support the level of claims outstanding. When paper and physical markets decouple, the question becomes which price is real. Goldman's target is based on physical supply and demand, effectively dismissing paper prices as increasingly irrelevant. That's a significant philosophical shift for an institution that has historically treated futures markets as authoritative. Goldman's competitive positioning also matters here. When Bank of America published a $309 target, it created pressure on other banks to justify their own outlooks. Goldman, which competes directly with BofA for institutional client business, couldn't stay at a materially lower target without looking like they missed the move. But Goldman also couldn't just match BofA's number without analysis to support it. The 267 target represents Goldman's effort to be credibly bullish without overextending. It's high enough to validate the structural thesis, but lower than BofA. which allows Goldman to position as bullish but not extreme. The competitive dynamic is part of why multiple banks are raising targets in close succession. The implications of Goldman's target for market participants are significant. For institutional investors, Overweight from Goldman is a permission structure to increase allocation. Many large funds have mandates that require them to follow research guidance from top-tier banks. When Goldman says Overweight, it gives portfolio managers cover to add silver exposure even if they personally have doubts. The 267 target provides a framework for sizing positions. If current price is 74 and the target is 267, you can calculate the risk-reward and determine appropriate allocation. That structure drives capital flows regardless of whether individual managers believe the target will be hit precisely. For industrial users, Goldman's target is a warning about input cost inflation. Companies that manufacture products requiring silver need to think about how $267 metal affects their economics. Can they pass costs through to customers? Can they redesign products to use less silver? Can they hedge exposure through long-term contracts? These aren't hypothetical planning exercises anymore. They're urgent questions driven by Wall Street's most credible commodity. Research endorsing prices that would dramatically alter cost structures across multiple industries. That urgency will drive physical buying as companies try to secure supply before the target is reached. For traders, the target creates clear levels to monitor. If silver is at 74 and Goldman says 267, the intermediate levels, 100, 150, 200, become focal points where positioning adjusts and momentum shifts occur. Traders will use the target as a roadmap, taking profits at intervals or adding on pullbacks based on distance to target. The target itself becomes part of the market's infrastructure, shaping behavior even among participants who don't necessarily believe it will be reached. That reflexivity is part of what makes high-profile targets self-fulfilling. Enough people position around them that the collective positioning moves prices toward them. Goldman's report also discusses risks to the target, though the treatment is brief. The main downside scenarios are a sudden supply surge from either new production or strategic reserve releases, a collapse in industrial demand due to recession, or policy reversals that reduce green energy mandates. Goldman assigns low probability to all three. New production can't materialize quickly enough. Recessions historically don't reduce silver demand proportionally because baseline industrial consumption is inelastic. Policy reversals are unlikely given the political capital already invested in energy transitions. The report's risk section reads more like an obligation to acknowledge downside than a genuine concern that the target won't be reached. What Goldman doesn't say is as interesting as what they do say. The report doesn't frame 267 as a blow-off top or a speculative mania. It doesn't discuss what happens after the target is reached. It doesn't suggest that investors should sell at 267. The implication is that 267 is a milestone on a longer journey, not a destination. That framing matters because it suggests Goldman views this as a structural repricing rather than a cyclical spike. If they thought silver would hit 267 and then crash, they'd hedge the call with exit timing. They don't. That omission speaks volumes. The revision also puts Goldman in an interesting position relative to their own trading operation. Goldman is one of the largest commodity dealers in the world. They take proprietary positions. They structure products for clients. They manage commodity indices. When their research desk publishes a target like this, it raises questions about how their trading desk is positioned. Are they long? Are they hedged? Are they using the research as cover to unwind positions into client buying? These questions are impossible to answer from outside, but they're part of why Goldman's research gets scrutinized more than most. The potential for conflicts of interest is real, even if Chinese walls theoretically separate research and trading. That said, the 267 target is credible precisely because Goldman has so much at stake. If the call is badly wrong, it damages their reputation with clients, undermines confidence in their research, and potentially creates losses in related business lines. The institution has strong incentives to be right. That doesn't guarantee correctness, but it does mean the target is backed by genuine conviction rather than being a throwaway forecast designed to generate attention. Goldman is betting institutional credibility on silver tripling. That's not a casual bet. One final point worth considering is the timeline. Goldman's target is 12 months. That's relatively short for a commodity call of this magnitude. It suggests Goldman believes the repricing will happen quickly, driven by near-term supply constraints and accelerating demand, rather than being a slow grind over many years. A 12-month timeline keeps the target measurable and accountable. Within a year, we'll know whether Goldman's call was prescient or premature. That accountability matters, because it means the research desk owns the outcome publicly. They can't hide behind long-time horizons or claim validation from long-term trends if the target doesn't materialize. The $267 target from Goldman Sachs is not just a number. It's a statement about market structure, supply dynamics, demand trajectories, and the limits of financial engineering in commodity markets. It's an admission that the old model's broke and a new framework is required. It's validation that the physical market is decoupling from paper markets in ways that traditional arbitrage can't correct. And it's a signal that Wall Street's most influential commodity research now views silver not as a speculative trade, but as a structural scarcity that price must resolve. Whether the target is perfectly calibrated matters less than whether the thesis is directionally correct. And on that question, Goldman just took a very public position.